Hi guys, Lucas Rogers here from the Rogers Property Group. I'd like to welcome you along today. Today we're going to be talking about tax because we're about a week away from the end of the financial year. And for a lot of you guys out there, you know, tax time means accounting from our properties and so forth. Now, a lot of people are under the false impression that accounting for a property investment is quite difficult, but in reality it's not at all. It's reasonably easy. There's four very simple things that you've got to have a look at, which we're going to go through now. First of all, what you do is you wait till July hits around and your property manager should send you out a management statement for your property. This is like a profit and loss statement for your investment. It's going to show you the amount of rent, so your income coming in from the property, and it's also going to show you management fees, any insurances they may have paid for you on your behalf, any repairs and maintenance they may have paid for you. So you're going to have an income and expenditure statement there. So that's going to form the basis of your accounting for your investment property. Second on the list, you've got to be looking for any extras that you might have spent out of your own bank account. So you might have paid for an electrician to come in and do something, or some termite inspections, or whatever it may be. So it's a good idea to go through your bank statements and see if there's anything that you may have missed there, and include that as well. Thirdly, depreciation. It amazes me how many people and how many accountants don't actually account for depreciation in their clients' property investments. Very, very important that you get a depreciation schedule or a quantity surveyor's report, which is the same thing. You get a quantity surveyor's report done for your property. Now, bear in mind that from earlier this year, you're no longer allowed to claim any second-hand fixtures and fittings in a depreciation schedule, okay? So if you've recently purchased a second-hand property, no longer are you allowed to claim the depreciation on any used fixtures and fittings. And that makes a huge difference to your cash flows. This is why we really encourage people to buy new property or to build new property, because that's going to raise the amount of depreciation that you get. Nonetheless, if you have a second-hand property, you're still able to claim the construction costs, okay, outside of the fixtures and fittings, so that's going to still be a major depreciation claim for you as well. And then finally, your interest repayments. You want to have a bank statement there showing 12 interest repayments going out, okay? Now, for those of you who have two loans relating to the one property, so you might have an equity loan and you might have a major part of the loan, so an 80% and maybe 20%. If the 20% equity loan is secured against your home, which is a non-deductible item, it doesn't matter. You're still able to claim that because the tax department doesn't care where the money's coming from. They care about where it's going to. They care about its purpose. And the equity loan is for the purpose of buying an investment property, so therefore the interest repayments on that are tax deductible as well. So there's the four things you want to wait for, or you want to look at. First of all, you get a management statement from your property manager. Secondly, scan your bank accounts to see whether there's anything that you may have missed, any extra repairs and maintenance, whatever that may be, any other expenses. Thirdly, make sure that you have a depreciation schedule done, and make sure that you're not claiming anything that's second-hand fixtures and fittings on a newly purchased property. And then finally, you want to make sure that you've accounted for all your interest repayments. So go through your bank statements, and if you've got two loans, make sure you include both of those as well. So guys, happy tax time, and we'll speak to you again soon. Thanks very much.